Well, it's time to kick off the show. I want to welcome everybody here, and I'm going to be talking about strategies. But, I was just reading. Have you read this book, The Psychology of Money, written by Morgan Housel? What a great book. What a great author. In fact, I had him on my podcast and got a chance to interview him a long time ago, just when the book was coming out. But I was just looking at this one quote in the book. It says, more than your salary, more than the size of your house, more than the prestige of your job, control over doing what you want, when you want to, with the people you want to, is the broadest lifestyle variable that makes people happy. He's talking about having control in your life, being able to live your life the way that you want, and that's the objective, ultimately, of wealth. So, I know we've got some people on. There's Deadpoo who has read it. Yep. Good to see everybody here. We're going to be talking about the strategy. And before we get started, I just want to say, please feel free to ask any questions in the comments. That's the whole point. We're here to explain, to discuss. Plus, I need your feedback, right? I want to hear what you're thinking about. What are the issues you're facing? We have 106 people right now on this call and on this video. And I just want to welcome everybody. Today, now we have a chance to look at the markets, stop and think about the markets, but most importantly, think from a long-term perspective. So let's get started. I'm going to share my screen and show you a little bit of what we've been looking at. So here you can see the all-weather strategies, and we'll talk about the performance in September and what's coming ahead. So remember, ask your questions in the chat. I'll answer them at the end of the presentation. I may answer some in the middle too, so don't hesitate. So White Knot also said, I read that book as well, such a good book about personal finance. Now, I did a study a long time ago of the best books in the world about finance, about management, about strategy, about all of that. And those books are right here on this shelf. And I have written summaries. Of these books. And I've written cheat sheets on every one of those books, and I've created courses. So for those people that are interested in that, we can talk about that later. But yes, Morgan Housel's book is amazing. So world stocks fell by 9.5% in September. Commodities were crushed, down 12.2%, and bonds were flat. That's what we just came out of. Let's look at the performance review of our strategies. The all-weather inflation guard was down a small amount by 3%. All-weather strategy was down 5.9%, and all-weather alpha focus was down 6.3%. So it was a painful month for all of us. Now, the global outlook I'm going to go through, and this is the outlook that guides our asset allocation. So let's first look at the performance of the world stock markets. Now, this data is as of the 10th of October, and we can see that the U.S. crashed in the past month, and China and most other Asian markets saw a significant drop as well. And the European market index fell slightly less. So let's take a look at the September performance. Remember, you can download this particular table at resources at valuationmasterclass.com. So world stocks have taken a hit in 2022. They're down by 9.5% in September. You can see that red line right there. Now in 2021, world stocks were up 19%, and we've given that all back. Year to date, they were down by 25.3%. The Thai money market stayed flat, which we can see there. Rather than global bonds, we primarily have allocations to the Thai money market and the Thai bond funds. The main purpose of our money market allocation is downside protection. And commodities were the worst performer in September, down 12.2%. That's painful. Commodities, of course, have been on a bull run since April of 2020. WTI oil fell and closed September at 2022 at $80 per barrel. Energy prices dragged down commodity performance in September, and agriculture was the best performer. Low inventories and expected adverse weather boosted agricultural commodities. And gold has fallen in 2022. It was down by 2.8% in September. Now, I'd like to just have you look at this line here, and what you can see is the gold line in this case is much less volatile. So part of the reason why we have the gold and the bonds in the strategy is because they are less volatile. Gold closed the month at $1,661 per ounce. Now, much of the recent weakness in gold is actually US dollar strength. So let's look at this for a moment. And I just want to grab my pen, and you can see dollar down, gold up. dollar down, gold up. Dollar up, gold down. Dollar up. Whoa, dollar up, gold up right there. You can see that happened during that time. And then we have dollar down, gold up, and then dollar up, gold down. So we can clearly see the correlations are negative here. Think of gold price as a currency pair. Typically, a stronger US dollar means a lower gold price in US dollars. This also means that gold performance differs in other currencies. So here we looked at currencies relative to gold. And what we were trying to understand is whether a currency is strengthening or weakening relative to an ounce of gold. And here what we can see is that the dollar strengthened year to date by 9%, and the Japanese yen, in this case, you can see weakened by 14%. This table helps us understand each currency relative to an ounce of gold. In September, the US dollar, the Swiss franc, and the euro could buy more gold. Other currencies remain almost flat. And you can see, if we look over the past 10 years, it was the Japanese yen that really was destroyed in value over time. And remember, Japan had a very serious quantitative easing and borrowing binge that devalued the currency. We also can see the British pound was also hit over that time. Now, inflation continued to rise in Germany. We can see that it hit double digits for the first time since World War II. Remember, war causes inflation to accelerate. The whole euro area saw a CPI of 10% in September as well. Now, while ECB tightens, the German government stimulates the economy. It's kind of crazy. They're tightening, but they're stimulating at the same time. Now, energy costs are a large part of inflation. Germany's producer prices rose a whopping 45.8%. However, producer prices without energy rose 14%. Inflation is more about energy. This is from J.S. Blokland, one of the Twitter posts that we looked at this week. Now, to worsen the EU gas supply situation, Nord Stream was sabotaged, allegedly. Here is the size of the Nord Stream pipeline gas leak. It's huge. And where are the ESG people who say ESG is important? Why aren't they screaming about this awful situation? Who did it? Who should be responsible for paying for the cleanup? What about all the animals that died? And here we can see a Polish political veteran and former minister thank the US on Twitter. This tweet has since been deleted. While media in developed Europe runs stories on why Putin did it, it appears that the US could also be behind this. The US probably stands to gain more from the blowing up of Nord Stream. So, who do you think did it? I'm curious. Crypto Loss says Russia. What about others? Have you looked at it? Have you looked at both sides? We haven't had an investigation, so it's hard to know. But any other thoughts of who did it? What about Germany? Could Germany have done it? What about England? What about the US? What about Russia? What about Ukraine? Maybe Ukraine could have done it. Who do you think did it? Can you put that into the show notes? Put it into the comments. Who do you think did it? So, German companies and the economy suffer greatly from gas supply disruptions. This is a great one from Macro Alf. He says, in Germany, $2 trillion of value added depends on $27 billion of gas from Russia. Here, what you can see is that the German industries are taking the gas and they're separating it into many different chemicals. They're creating many different products. They're creating fertilizer. They're adding a ton of value, and that value is now destroyed. Okay, so here we have some answers from people. Say, who did this? Nord Stream. We see that Deadpoo says, God knows. Nan says, U.S. Navy SEALs. Crypto Law says, Russia or OPEC. That's right. Could have been maybe the Saudis. Maybe they sent a submarine there. Could be. Natural gas prices feed into fertilizer, which feeds into the food supply chain. And what's been interesting is that we saw a big rise in the price of fertilizer. Then it kind of came off again, and now we're seeing it start to rise again. And this chart is fantastic. It's scary. It's terrifying. Over 3 billion people would starve to death without fertilizer made from natural gas. Let's look at this chart in more detail. Here we can see that high fertilizer prices or supply shutdowns hurt the poor the worst. Here we can see that the population fed by synthetic fertilizer is this section right here. And basically we can see that it is about 3 to 4 billion people. Without fertilizer, we don't have the food production and output. Now, I do see another one, DRMAW, Dr. Mia Wabel, who says the humans did it. Yes, I think you're right there. Now, here we can see that the Fed hiked by 75 basis points to battle inflation. And Lynn Alden, one of the great ones on Twitter, said back then the whole world would stop and listen to one guy say what he was going to do with the price of money. It's nonsense to have a committee set the price of money. I'm a libertarian, and I believe that we need free markets to set the price of things. After all, look at the things that we buy. We don't need government setting prices for books, for iPhones, and for all of that. Before I continue, I just want to thank everybody for attending. We have 153 people on the call. And remember, now's your chance to ask questions. Take your time to type them in the chat. You can type them in Thai or you can type them in English. If they're in Thai, I'll try to read them or get some help from someone. But feel free to ask questions. All right, back to the presentation. So this chart also is interesting. This is the fastest rate hike cycle by the Fed since the 1980s. Now, previously, a few months ago, I was talking about how the Fed is going to raise interest rates into a recession. It's the exact opposite of what there's taught in all the economics textbooks about Keynesian economics. But here we can see that in this cycle, they've moved 3 percentage points in only 6 months. No other tightening cycle was anything like it. And if it continues on, what you're going to see is that they're going to add on another 75 basis points probably and get it to here. And that is going to be, actually, I'll take it out here. It's going to be about right there. So right at that point, it's still the fastest and most aggressive. So the point that I would make is that you can see that the Fed is trying to crash the economy. So, but will the rate hikes be enough to stifle inflation? Here we can look at a chart that shows that inflation decomposition by factors. What's the number one factor? The number one factor is energy. What's the second factor? Supply shortage that we have because of the shutdown during the COVID time. These are factors that aren't necessarily impacted by the interest rate. Rate hikes typically reduce demand, though besides energy, inflation seems to be driven by supply side issues, not demand. Now, the market thinks that the Fed actions will reduce the inflation. Here's an excellent chart, and this chart shows the 10-year U.S. break-even inflation rate, and that right now is at about 2%. That means that if you thought, if the bond market had a 10-year bond with a yield of 3%, and the market has already factored in 2%, that means that you're getting a positive 1% real return or real yield. This is important because most of the time when people, if we look at time zero today, and we look at inflation, most people look at inflation over the past few years, and they can say, well, inflation's been up at like 8%. And instead, they don't use 2% like we see right here. They're going to use 8%. So they'll say 3% minus the 8% means it's minus 5%, and they'll say that real interest rates are negative when in fact they're positive. So which one is right? This one is wrong. What we want to be able to do is look at a 10-year forecast of what inflation will be. And it's not going to be 8% that high. What inflation is probably going to be over 10 years is more like 2 to 3%. Now, maybe the market's a little bit optimistic by saying 2%, let's say 2 to 3%. And that's how you calculate the real return. Now, the Fed hikes have also been reflected in the US stock market performance. Everything is down. And recently, the Bank of England reversed course when something was about to break. The Bank of England decided to intervene to get ahead of the political crisis. This chart is of 30-year UK bonds, and the yields on those bonds were exploding. When yields are rising, it means that price is falling. And as the price was falling, companies and particularly pension funds were losing money on those investments. So what happened? Basically, the government came in and started buying those 30-year bonds. And when they did, the yield started to come down. And in fact, the buying was super sharp that pushed the price back up. Whenever the government starts buying, it causes a massive move in the price. So this shows what we've argued, that central banks are going to stop tightening as soon as something breaks. Now, the U.S. firms appear to expect a recession. Again, Macro Alf tells us that almost half of S&P 500 constituents cited recession during their second quarter earnings. That's the highest amount in 10 years. Everybody in America, most people are expecting a recession. Now, on a positive note, if you're young, lower stock prices mean more buying opportunities. And that you have that entry point. And so for DCA, now's the time to make sure that you're making the contributions. Now, at a 20% decline in the market, you're expected to make a 40% return in 3 years. This is some research going back over the past. It doesn't mean that it's going to be the case going forward, but that was the case going past. I did some research on this also a while ago to try to understand what happens over a 1 year, 3 year, 5 year period. And basically almost every single significant fall in the market comes back in about 3 years. And also at about 5 years, almost all of it is back. So markets do bounce back. We can say that stocks don't necessarily, a stock could go bankrupt, but markets tend to bounce back. I just want to take a moment to welcome everybody here. I see that you guys are asking questions. Grid has asked a question about outlook for crude. Piawat has asked the question, what happens on the period that gold and US dollar are the same direction? I think that was during the COVID lockdowns. And I'm going to ask Alex, who's on the line, just to go into that place that I showed in the chart where the dollar and gold were moving in the same direction. I believe it was a time of COVID. So we'll get an answer on that in a bit. But Anucha has got a question. Is gold still a safe haven for 3 to 5 years horizon? Is 25% of portfolio advisable? All right, I'm going to come back to that and we're going to go through that. Keep those questions coming and I'll do my best to answer them at the end. All right, let's go back into the presentation and I'm going to tell you the key takeaways from this section. Inflation continues to race up. Destroyed Nord Stream could worsen the European energy crisis. And central banks are raising rates into a recession. And on a positive note, lower stock prices mean buying opportunities. Let's go through the strategies. First, we're looking at the inflation guard strategy, our low risk strategy. And that strategy is allocated about 30% to equity and about 60% to bonds. We make no change in this performance review. So here we can see that it was down 3% in September, slightly better than the 40-60 strategy, which was down 3.6%. Since inception, all-weather inflation guard has outperformed a 40-60 strategy by about 2.1%. That's as of the 10th of October, 2022, and since inception. Here we can see that inflation guard was down the strategy was 0.6% better than that 40-60 portfolio. So only slightly better. And also, I'm going to ask Alex to help me here. At the bottom, you're going to see a note, and it says that the 40-60 strategy is the NAV of the time mutual funds used in the strategy. I just got to ask Alex if the 40-60 has fees in it, and if obviously the inflation guard has fees in it. And so I think we've put fees into these so that they're comparable. Alex, if you can make a note in the next one so that I just understand that clearly. All right, let's talk about all weather strategy, which was down 5.9%. It was painful. So we make no changes in the strategy. We're still at 25% in each asset class. All weather strategy was down 5.9% in September, slightly worse than the 60-40 portfolio, which was down 5.7%. Since inception, the strategy was 9.6% above a 60-40 portfolio. That's as of the 10th of October. So here, what we can see is that it was 0.2% below the 60-40 strategy. Let's review our allocations, right? The best performing ones were gold and bonds, and gold was down, but the second best performing asset class. And then commodities got crushed. It really was a difficult time for commodities. So AWS has lost less on 9 out of the 10 worst global stock market days. Remember, it's a long-term game. I know that people ask me all the time, well, should I get in? Should I get out now? The fact is that if you want to grow your wealth, you got to do that by contributing on a consistent basis. In fact, I think I'm just going to mention, some of you guys may have seen that I've started a show with Phenomena called Your Wealth Engine. And in it, it's a show that helps you create, grow, and protect your wealth. And one of the things that's really important, obviously, we try to create our wealth through business, through salary, through the main ways that we can do it. But we also need to grow our wealth over a long period of time, 20, 30, 40 years, depending on your age. And that's part of the reason why you'll see that I'm not the type of person that gets too upset or too frustrated when we have a bad time. Why? Because I know it can come back. It will come back. It's a little bit different than investing in individual stocks where the risks are much higher. And that's part of the benefit of being in this strategy. So just to go back and look at this a little bit more, a key feature of AWS is that it aims to lose less when equity markets fall. Of the 10 worst days of global equity since inception of AWS, the strategy has lost less than 60-40 or 90% of the days. So AWS underperformed in September, but outperformed a 60-40 in 60% of months. Now, we did underperform, as you can see right here. There was underperformance in this particular month. We have had some periods of underperformance for sure. In 26 out of 43 months, the all-weather has beaten a traditional 60-40 strategy. But that basically means that there was also a lot of months that we did not beat it. Now let's look at Alpha Focus, where we're trying to do a higher risk strategy. And just as you would think, the low risk strategy is down the lowest, the mid risk strategy is down the mid amount, and then the high risk strategy is down the most. And hopefully that means that it's also going to be up the most when things get better. So here we can see that our equity is at 63% and gold is at 20% right now. We make no changes in this performance review for Alpha Focus. Here we can see that Alpha Focus was down 6.3% in September, worse than the 5.5% fall in the 60-40. So since inception, Alpha Focus was 1.1% above the 60-40 portfolio as of the 10th of October. Now, Alpha Focus was down 6.3% in September, but that was better than world equity, which was down 9.5%. So if somebody just decided they just want to put money into the stock market and they put it in world equity, they would have been down 25% since we started the Alpha Focus strategy, whereas we're down 86%. So since inception, Alpha Focus was 10.7 above that world equity. Now, I just wanted to talk briefly about the concept of absolute versus relative performance. I remember many years ago when I first came to Thailand, I became an analyst in 1993. In about 1996, 1997, I went to London and I met a fund manager, and he used to have the same job as me. I was the head of research at WI Carr, a foreign broker in Thailand. And we sat down, and I had done a study on Thailand. I think it was about 1996 that I was presenting to him in London. And he just asked me, are you positive or are you negative on Thailand? I said, I'm negative because there's been so much debt built up. And that debt is supporting the ROE, the return on equity of the companies. But that's not the way to get good profitability in a company. And he said, yes, he is also negative. And as a result of being negative, he is going short, not only the market and individual stocks, but also the currency. In the end, his name is George Robinson, and George Robinson was right. And he made millions of dollars by shorting the Thai baht, by shorting Thai stocks, and by taking a negative stance at that time. And basically, that is absolute performance, where you're trying to outperform in both up and down markets. It's a dream, but very few people are really good at it. And truthfully, 10 years later, he set up a fund, and 10 years after that, the fund eventually shut down. So nobody has like a golden or a Midas touch. We have to just keep grinding away at it. And in that case, it is frustrating for anybody who has put money in and has seen it fall. But remember, we're looking at long-term. So sometimes people get annoyed when someone like myself talks about relative performance, and I say, hey, you're only down 85 down to 85.8. You would have been down by 75. Well, still being down by 15% is huge for anybody. So I definitely understand that, but I do know that I'm not trying to go short the market. And that's the difference between an absolute strategy and a relative strategy. And this strategy is a relative strategy. Now, Alpha Focus was 0.8% worse than the 60-40 portfolio, though Alpha Focus was 3.2% above world equity, as we talked about. Our bigger tilts to bonds, gold, and world healthcare helped the performance relative to world equity. So let's look at the outlook that guides our asset allocation. First, let's talk about equity. Oil prices retreating, but not yet inflation. The green line started coming down, but inflation continues to race up. And there is some lag effect in the oil price and inflation. Oil is a key energy source for agricultural, manufacturing, and transportation. And oil prices falling back, which could lead to slowing or falling inflation. Though CPI has reached new heights, I don't see that CPI is going to come crashing down. It's possible if they crash the economy. Look at CPI here. If we look at the red line right here, that's 2007, and then it came crashing down in 2008 because the market and the economy was crashing. I think the Fed is actually doing that right now. So we may see that we're near the peak, and we start to see that inflation come back down. Now, inflation right now, though, is through the roof. Higher prices at some point reduces demand. And a higher base is also likely to reduce the inflation rate going forward. So inflation could be close to a peak even without central bank intervention. And of course, that's when it gets messed up, right? When the central bank goes in there and starts messing around with it, they end up causing a problem. And Canada and the US are at about 7 or 8%. Hong Kong, China, and Japan are about 2 to 3%. Singapore, Thailand are at about 7 to 8%. Pakistan is in serious trouble, unfortunately, at 25% inflation rate. Switzerland's at 3.4, pretty low, and France at 5.9, and Norway, not bad compared to Poland at 16%, Czech Republic, and Ukraine, 16 to 23%. Eastern European countries are being hit, of course. Now, before I continue on, remember to ask your questions, and I'm going to do I'm going to answer those at the end of the session. Now, while higher interest rates, slower growth, and softer labor market conditions will bring down inflation, they will also bring some pain to households and businesses. Well, that's exactly right. Chairman Powell is bringing a huge amount of pain on people. These are the unfortunate costs of reducing inflation, but a failure to restore price stability would mean far greater pain. Jay Powell is saying that he's willing to bring pain on the people to get down inflation. Now, I just want to talk about that for a moment. The Fed kept interest rates at almost zero for 15 years. And then everything exploded. And now everybody, in particular the US government, is sitting on a massive amount of debt. And now the only thing they have left is to try to bring down inflation, and they're going to crash the economy. Don't ever trust committees or central bankers. They are not better than the market at setting the price of money. Okay, so let's continue on. Keep your questions coming. I see Anu Cha has asked a question. So a Fed rate hike is priced in for November. The market is pricing 100% certainty of another Fed rate hike at the next FOMC meeting. The implied probability is 78% for a 75 basis point hike to a target rate of 3.75 to 4. Now, only the Bank of England is expected to raise rates higher than the Fed, and you can see it happening right here as rates are rising and expectations of rates are rising. The ECB is raising rates, but not anywhere near where the Fed is. And that's part of the reason why there's the weakness in the euro. And it's also obviously weakness in the yen. Here we can see because the gap between US returns and Japanese is very large. Now, when international investors are investing around the world, they oftentimes hedge their position. So we have to look at the cost of hedging when we look at a foreign bank investing in, for instance, US treasuries. But that's a more complicated issue. Now, the other central banks are expected to follow the Fed in rate hikes. The expected lower rates in the EU and Japan lead us to expect a weak euro and yen against the dollar to continue. Now, yield curve inversion is diving deeper. All recessions in the US since 1970 were preceded by an inverted yield curve, and that is where we are. When the red line is below the 0 point, it basically means that we now have yield curve inversion, and that's basically meaning that short-term interest rates set by the Fed are higher than long-term, and that also means that we could expect a recession in 2023. In fact, it may come right now. Yields are racing up, which is raising real interest rates. We can see the red line is the real interest rates starting to rise, and that's driven mainly by the fact that the Treasury yields have been shooting up. Think about that. The 10-year Treasury yield right here at this point was about 0.75 at this point, even 0.5. And now we can see that it's at nearly 4. That is a massive increase that we're experiencing. Now, low interest rates, low real interest rates in the past had pushed investors into higher risk assets. Rising real interest rates benefit newly issued bonds. So if you're buying those bonds, you're going to benefit from a higher yielding bond, but they hurt long maturity bond portfolios. They hurt equity, they hurt commodities, and they hurt gold. Now, I like to watch for this is where I think we'll see a break here or in the real estate market. And here what we see is the yield spread. This is the spread between high yield. And so let's just say that the high yield are 12%, let's say, for high yield bonds. And let's say that the government bond rate is 4%. And therefore, what we have is an 8% premium, right? And that's about, let's say, about right here, an 8% premium at that point. Now, in the COVID time, when that premium happened, basically it means that the bond markets are starting to freeze up. And nobody wants to buy junk bonds because they think that the recession is going to be bad and these companies can't pay back the money. So they're all selling. The price of those bonds are falling and the yields are rising. And that's what's going on. Now, a wider high yield spread shows investors are demanding higher yields to bear that risk. EU has hit a level similar to that reached during the COVID crash, while the US is still below. My point is that this can shoot up real fast. As we can see in pretty much almost all of the prior situations, it shoots up really fast. And I believe that the Fed, once that thing really shoots up, maybe to here, we see it come up to there, and then the Fed will intervene. And that is the Powell pivot or the Fed pivot. Now, this is a look at consensus estimates of EPS in the US. And what we can see is that for the year ahead, analysts are expecting 8% growth. For the year, 2 years ahead, they're expecting roughly 8.5% growth. And 3 years ahead, they're expecting about, let's say, 9% growth. That is what I would call good times. Analysts expect 8% one-year earnings growth in the US and for earnings to accelerate from there. Now, let's look at other regions in the world, and we can see that in almost every case, 2 years ahead is coming down. Things are looking worse. So we've had an adjustment to earnings, but we haven't had it in the US. So the second part of the downfall of the US market, you could argue, is when analysts start to knock down their forecasts for the future period. Once that happens, when those earnings get cut, the PEs of the companies are going to rise. And as the PEs rise, the market's going to drive those PEs down. And so there's a lot of risk that shows up in this chart. Now, the ECB is following the Fed. Like the Fed, ECB reiterates its commitment to combat inflation. Inflation was at 10% in September in the euro area. 0.5% hikes at the September 8th meeting, and further hikes are expected in October. ECB will try to at least keep up with the Fed in terms of hikes. If not, the euro would weaken further and exacerbate the trade deficit. Here we can see there hasn't been much QT, and I think it won't be long from now when we start to see the Fed drift down and then have to pivot and have to inject money into the market. So we think the course will eventually be reversed. Many central banks are communicating that they're going to get inflation down, and investors seem to buy that rhetoric. We still think central bankers and politicians will change course and return to accommodative policies as soon as something breaks. In other words, we're going to see QT get stopped and it becomes QE. And that means they're going to be adding liquidity to the market, which is going to fuel inflation, but it's going to save the market. Don't believe me? Well, you can see it in the UK happening already. The Bank of England reversed course as soon as things were about to break. The UK government bond yields raced up and the British pound crashed as the UK government proposed budget deficits. Rocketing yields led to margin calls on certain pension schemes, and the Bank of England stepped in as a buyer of last resort and is committed to continued intervention. This shows that central banks are going back to QE when things are about to break, and this is what I believe is going to happen. Before we continue on, I just want to thank everybody for being on the show. I know you have a lot of things to do in your day and in your life, and I appreciate that you spent the time with me, and feel free to use that time to ask any questions. I see we've got some good questions that are coming in. I'm just looking at them over there, and I'm getting my head ready for them. And I see we have about 192 people in the group, so keep up the good work, keep asking questions, and we'll get to those. Now, stagflation is the worst possible outcome. If central banks manage to kill growth but not inflation, we'll get stagflation. It's typically bad for both stocks and bonds. Commodities have typically done well during inflationary times, and gold has historically fared well during stagflation. Now, the strong US dollar, of course, is crushing emerging markets. Fed actions are likely to result in a stronger dollar and less global liquidity, which could hurt emerging markets. US dollar is considered a safe haven. It can strengthen further as a result of the global turmoil. I would say you still have the possibility of strengthening the US dollar, but at some point that's going to reverse. Poorer emerging markets in Asia could be hurt by the European energy crisis. Here we can see Europe is so desperate for natural gas that it's importing an LNG cargo from Australia. And here what we can see is that that cargo is going through the Straits of Malacca. And the Straits of Malacca here is a place where the US could cut off the supply of oil to China. And that's one really serious place. As Europe is desperately trying to find enough energy, prices could rise. And richer countries are likely to outbid poorer countries for energy. Plus, richer countries can just print their currency. And if they can do that, then they have an opportunity. This hurts poorer countries' energy supply. If Thailand was to start printing money, we know what would happen to the value of the baht. It would be depressed. Now, the strong dollar and China are concerns. A stronger dollar is negative for many Asian markets due to dollar-denominated debt getting harder to pay back. And we're not yet convinced about the Chinese recovery. The Chinese government is trying to support the economy, but appears cautious not to use too much stimulus. We're not yet convinced, as I say, about the recovery in China, and a stronger US dollar is negative for many Asian markets due to US dollar-denominated debt. The Chinese government is trying to support the economy, but appears cautious not to use too much stimulus. Let's talk about bonds. Bonds are typically a safe place to be. In recessions, safer assets like government bonds are typically performing well. Though with high inflation, low yields could still lead to negative real returns. We typically don't allocate to bonds to speculate on the upside, but rather use the bonds as a way to protect capital over time. Let's talk about commodities. Here we can see energy prices are super high in Europe, and Europe's Russian energy dependence is continuing to influence the energy markets. OPEC Plus keeps missing its output targets, and the cartel has announced further production cut targets. Fundamental support for energy prices, well, the Ukraine war could lead to further supply shocks. Nord Stream explosions show the shock that comes from war. And energy prices can also remain high due to past underinvestment in new projects. You may say, Andrew, why would the energy companies have underinvestment? Well, because ESG forced them to do that. Now, the supply for agricultural commodities could tighten further. Besides energy, Russia is an exporter of many industrial metals, and Russia and Ukraine are both important exporters of soft commodities. La Niña could reduce the supply of important commodities like corn, soybean, and wheat. High energy prices feed through to food. Cereals rebounded slightly in September. There's a tiny, tiny little rebound right there that's starting to happen. Of course, there's a fall in meats, in the cost of meats. Natural gas is used in fertilizers. Pricier fertilizer means higher grain price. One of the world's largest fertilizer producers has cut their production by 50%. And corn is a common feed of livestock and poultry, and that's driving up, of course, meat prices. The World Crude Price Index hit a record of 160 in March. Still, it's at 136, but the good news is that it's been coming down. But I would argue that it doesn't come down forever, because I think you still have a lot of problems with the production of food, with the growing of food. Export bans on food could exacerbate the shortages and push prices further. And oils and cereals have been the primary reason for the fall. Meat and dairy are still around March 2022 levels. Now, commodities are set to go higher. Demand for necessities, inflation, and supply chain disruptions related and unrelated to the war in Ukraine are going to drive the asset class higher, or at least I think so. A reopening of China could lead to increased demand for commodities. And also, if we were to go into a stagflationary period, commodities should show some resilience. And finally, let's look at gold. We keep gold as an insurance policy, and you can see markets crash, but gold come down a bit. The war in Ukraine spurs uncertainty, and inflation expectations could rise, making gold attractive. Though expected rate hikes are negative, as interest rates rise, it makes higher yielding bonds look attractive, that gold's not yielding anything. And that's the reason why interest rates are low, or real interest rates are low. Gold is kind of like a bond because the bond's not paying much interest and gold doesn't pay any interest. But when the bonds start getting higher and higher and higher yield, all of a sudden they become different asset classes at that time. So in general, gold protects value in market downturns. So what are the risks? Global recession pushing down stocks. If major central banks would surprise and be too aggressive with rate hikes in QT, it could crash the stock markets. And collapsing energy prices would be damaging since we have exposure through our allocations to world energy and commodities. And we are mainly exposed to Thai bonds. Hence, the Bank of Thailand's actions impact the most. The key takeaways from this section. Central bankers appear to be raising rates into a recession to stifle inflation. Stagflation would be the worst outcome. Demand for necessities, inflation, and supply chain disruptions can drive commodities higher. And we see opportunities to allocate to specific sectors and markets within equity, bonds, and gold we use to protect capital. Finally, what are the risks? Monetary tightening, crashing the markets, collapsing energy prices, and Bank of Thailand actions. Now, just to wrap up, yesterday we kicked off the Valuation Masterclass Bootcamp 6, and it was a great time at the kickoff. Bootcamp number 7 starts January 9th. So if you're interested, we have a super early birds price available. And with a phenomena, you can save an extra $100. So get an extra $100 off on any price point. Currently, you would save about $800. Just use this coupon code at valuationmasterclass.com/bootcamp. Just use phenomena. All right, Q&A time. Let's do it. Now, I'm going to turn to my left to look at some of the questions. I'm going to go back up to the top. And let's look at the first question. First question came from Jaruwit. Can I use DCA with your all-weather and all-weather inflation guard plan? Yeah, I think the point of DCA is that you set the same amount every single month and you contribute on a consistent basis. When the markets are going down, you're buying more shares. When the market is going up, you're buying less shares. So you want that to happen all throughout the time. Now, why is it important when you think of it in relation to all the different all-weather strategies? It's important because I am making the strategy allocations. Now, normally, if you don't have anybody that you're following, that you're getting advice from, you're just going to basically try to go in and out of the market, maybe go more into gold, more into bonds, but that allocation is what I'm doing. So if you are copycatting and following my strategy through Phenomena with your advisor or on the Phenomena platform, I'm doing that allocation. So when I bring my equity allocation down to 25% in the all-weather strategy, it means that I'm turned negative on the market. And therefore, I'm doing some active asset allocation so that you don't have to. So yes, I would do DCA, not only with mine, but any other. All right, let's look at the next question. Grid says, what's your outlook on crude oil for 2022 and 2023? It's a difficult question, I would say. The first thing is that the market is probably anticipating Republicans to win in the election. And if Republicans win the House and potentially win the Senate, which I think would be a surprise, but that's what I'm forecasting, then the Republicans would have control of the Congress. They won't have control of the presidency because Biden can veto anything, but they'll have the ability to propose all kinds of things. And I think that the Republicans will propose that U.S. start pumping more oil. And I think that's part of why oil prices fallen. But there's no way they're going to be able to catch up with demand. And so I think that we probably have a rising oil price now until maybe another 6 months from now. And then eventually that's going to be exhausted. Now, if the world and the markets crash, that oil price forecast could come down. All right, next question from P. Awat. What happens on the period that gold and U.S. are going the same direction? That period was from January 2020 to May of 2020. And basically that was during the time of the pandemic when people started getting panicky, and we can see that gold and the US dollar both moved in the same direction at that time, because basically during a time of high risk, all assets tend to get correlated, and I think that's really what happened. Anucha says, is gold still a safe haven for 3 to 5 years? Is 25% of the portfolio advisable? I would say that 25% of a portfolio in gold is pretty high, and commodities too. I mean, I'm really pushing the limit by having 25% commodities and 25% gold. And I would say that if I was an individual investor, I would not have so much in gold and not have so much in commodities. Maybe you've got, you know, let's just say you have 60% in the market. Let's say you have, let's say that you have 20% in fixed income or bonds. Then the remaining I would split between commodities and gold. All right, let's see. Crypto Loss says, what's the all-weather strategy really is? Is it founded by Ray Dalio? Our all-weather strategy is very different from Ray Dalio's. What he's doing is an active strategy, and he's making tremendous number of bets in the markets across the world in individual stocks. And we are generally invested in funds. So he's trying also to figure out how he can make money in a down market. And I'm not trying to do that, because there's a lot of risks involved with that, and we don't have as much instruments to do that. All right, next question. Dead Pooh says, what if Fed hike has no effect? Can it possible that we're still stuck in stagflation? I think it's possible. I mean, the whole point about the Fed moves is that the Fed moves should be a surprise to the market. If the market's already expecting it, then the market won't move very much. So I would say that it is possible that we get stuck in stagflation. Nan says, Fed action will continue until something breaks. What could be expected to break that could change the Fed action in your view? So the first thing is the real estate market. At this level of interest rates have gone from 3 to 6 or 7%. That's going to really, really hit the market hard. And the second thing, I don't think there's going to be a banking crisis in the US, because the banks have a lot of cash and safe assets on their balance sheet. But what I do think is the equity market will continue to fall right now, and that's the type of thing that's going to break. I would also say that the high yield bonds, and just bonds in general for not the big name famous companies, could crash, and then that again tempts the government to step in. All right, Anucha says, what will fall first, inflation or oil price? It's generally going to be oil price that's going to fall first, because inflation is just, oil price is one part of inflation. And so inflation is a little bit lagged, but oil price, we can see the price every day. Next question from Jutamat. If dollar is stronger, US can import cheaper goods and inflation should be lower in the US, assuming that supply is not an issue, like COVID policy in China. Yeah, so when the US dollar is strengthening, it means that all the goods that the US is buying from outside world is getting cheaper. And that is happening in relative terms for the US. And so there is some pressure coming off inflation because of the strong dollar. Remember, that strong dollar, though, is hurting the rest of the world. But yes, you are correct to say that that's the case. Imagine if we didn't have a strong dollar, where would the US inflation rate be? It may be at 12 or 15% as we see in some other countries that don't have the reserve currency status. So PNKKKHAGG says, US recession next year? Yeah, I think it's possible. I think we're seeing the markets anticipate that. I think it's possible by the end of this year and into the second quarter, we'll probably see recession in the US. Supercorn Jane says, what do you think about the debt situation in emerging markets after the Fed interest rate? Well, the debt in emerging markets is it's an interesting thing. We do have some markets in Asia that are pegged to the dollar, like Hong Kong and Singapore. So those interest rates have been following what's happening in the dollar. Now, what I would say about Asia and let's say Thailand and other countries is that they don't have as much debt as the US. China does have a lot of debt, but I would say generally countries in Asia don't have a lot of debt, and except for Japan as another example. But Thailand does not have a huge amount of debt. Also, the amount of US dollar debt is pretty minimal for many countries in Asia because they still remember the 1997 crisis. So I'm not too worried about, let's say, a debt collapse in Asia. But the key thing is that Asia doesn't have the Fed, and the Fed is the one that's stepping in. So I may have to have somebody help me with the translation. For Ansel asks, Yangจะชวนลงทุนอีกหรือปีนี้? So I think what you're asking is, should I keep putting in investment? I'm not exactly sure what you're asking, but I would say that with a long-term time horizon, you've got to be buying when the market is down, when you don't feel comfortable. So, okay, White Knox says, if I'm interested in momentum investing style, could you recommend books or research papers for me to further study? Yeah, you know, there's a guy that I like to follow, and I'll have to ask. I think it's called Alpha Architect. Alpha Architect. I would follow him. His LinkedIn or Twitter or whatever has got some excellent papers on not only momentum, but many other things. If Alex is still on the call, I'll ask him to put in a link to Alpha Architect. I follow his LinkedIn posts, and he has a weekly email that he comes out with research that's very, very excellent research and well explained. All right. Anucha says, thank you so much, Ajahn Andrew. This is a lot of intelligence to digest. Yes, there's a lot of stuff going on. Dead Poo says, hearts, hearts, hearts. All right. Nan says, asset allocation isn't working this year. When things get better 2 years from now, U.S. will come back first. What sectors? Yeah, I think that I would say that the next big move is not the U.S. The next big move is emerging markets. We're going to see at some point the US dollar start to fall, maybe even crash. And when it does, emerging markets should be relatively strong. And also remember that interest rates never went down to zero in most of the emerging markets. And even if the government central banks were bringing the interest rate down to zero, the banks weren't playing that game. They kept interest rates high. So I'm a little bit less worried about emerging markets. I mean, some emerging markets, let's say Pakistan, which is, you know, maybe more of a frontier, but maybe emerging market, you know, they're in a lot of trouble. But countries like Thailand and in Malaysia, Indonesia, as an example, are not in as much trouble. All right. Saleh DC says, when will US dollar hit its peak? Does the US gain benefits from higher value dollar? Yeah, what the US, I would say we're probably getting close to the peak. Maybe another, let's say another 3 to 6 months, and then we're probably at the peak. And what the US is gaining is it's causing suffering in every other country in the world. And the result of that suffering basically means the US is getting stronger. Also, the US is gaining, as we heard about inflation. When the US dollar is strong, the goods and services that the U.S. is buying, they're buying them with a stronger dollar. That means it lowers their prices of those items coming in. And also, the effect in the U.S. is also an issue because many of the conversions of foreign currency earnings, let's say Apple earns a lot of money outside of the U.S. So when the U.S. dollar is appreciating, the income that Apple is earning outside is worth less. So there is also an impact on the profits and the revenues of companies. Salia says, will it be a soft landing? I think it's not that easy to do a soft landing. And you saw how fast the Fed is increasing those Fed fund rates faster than they've ever done. I would say it's probably more likely to be a hard landing. Next one, Supercorn Jane says, what do you think about geopolitical risk? I think it's very high. In fact, I think that World War III has already happened. And World War III was when the U.S. destroyed Europe's power, basically. And now Europe has to follow what the U.S. does. And as a result, I think that political risks are very high. And I think that the leaders in the American government, the head of the NSA, Jake Sullivan, the head of the State Department, Blinken, and then the head of the CIA, these guys are messing around. They're not negotiating and talking to Putin. And in the end, they will eventually create a war. And they'll do it, and it will happen all of a sudden. And it could be happening right now when they blew up Nord Stream. Then they blew up the bridge that connected Russia to Crimea. And now Russia is retaliating. These types of retaliatory actions eventually can very easily lead to war. And I think that's the reason why, people should be very cautious at this time. All right. Su Chua-chan says, I can't find QT data. Could you please help? Quantitative tightening data, the best place to go is to the Fed. Just type in FRED, St. Louis, and you'll find the data on the Fed. All right. We have reached the end of the show. It's 8:06. You guys have had a lot of questions, and I really appreciate all the questions. You made me think, and I continue to think. I think that's one of the things I love about the world of finance, is that it's all about thinking. This gives you an update on our strategies, the way I'm looking at things. And in a month, I'll be back on to give you more information. Meanwhile, if you're up at 7 a.m. on Monday mornings, join my show, Your Wealth Engine, where we talk about how to create, grow, and protect your wealth. I want to say to everyone, and also for the question about QT data, I put a link right there that you can see, St. Louis Fed, and you can go to that, and that's where you can get some of the QT data. The main thing is just to get the Fed balance sheet so you understand whether they're buying or selling securities. I want to thank everybody for joining tonight, all your great questions. I hope to see you on the 7 a.m. show. And more importantly, I want to thank Phenomena for bringing us together. Phenomena is an amazing company with a lot of dedicated people doing a lot of innovative stuff to reach you with great material, but also with great services, with advisors and all kinds of help. So I want to thank you guys and Phenomena. Have a great evening, and I will see you soon.
ราคาน้ำมันขึ้นราคาที่ดินก็คงจะต้องเพิ่มขึ้นตามมาด้วยนะคะโดยที่ได้มีการประกาศออกมาแล้วล่ะค่ะว่าในปี 2566 นี้ราคาประเมินของที่ดินเนี่ยจะมีการปรับเพิ่มขึ้นมาประมาณ 8% ค่ะมันคือยังไงนะคะแล้วก็เราจะได้รับผลกระทบยังไงบ้างหรือเปล่ามาเรียนรู้กันในคลิปนี้ค่ะ